We're going to take a closer look at RIL and its numbers. Now, it reported its fourth quarter earnings on Friday, and Ajay is here to take us through the numbers exactly. Ajay, disappointed the markets, but tell us what exactly happened.
Well, Reliance Industries' fourth quarter profits were mostly in line with estimates. A fall of 21% on the net profit front was compared to 19% fall, which ET now was actually estimating, more or less in line with estimates. But there was a green shoot over there. $7.6 a barrel GRMs were almost matching with the Singapore complex, whereas the street was actually estimating a weakness on that front too. $6.5 a barrel is what the estimates were. But the company managed to shore up its gross refining margins, which has gone down well with the analysts on the street. But if you look into the segmental performance, the petchem side of the business saw some weakness coming in on a sequential basis. Refining margins, refining side of the business, 2.2% was actually flat sequential. It was the gas side of the business which actually saw a very big fall, 36% odd, because of the low volumes which the company is clocking right now from its prolific block KG-D6.
All right, Ajay, thank you for that information. Joining us now to help us understand those RIL results better and to give us some tips on the best investment options in the market right now is Jagannathan Tunuguntla, the Head of Research at SMC Global. Jagannathan, thank you so much for joining us on this show. Now, like Ajay was telling us, the RIL results showed slowing growth in profits, falling margins across all of its businesses. The output from the KG gas basin has fallen 23% in the last year. Tell us what it means for investors who are holding that RIL stock right now. How do we interpret all of this information?
I think it has been a while that Reliance has come out with anything surprising and anything positive. And moreover, their falling gas production and despite their joint venture with British Petroleum suggests that the problems are much more longer term than market expectation. And moreover, just spare a thought, if you look at the financials more closely this quarter, 42% of the profit is coming out of other income. What it means is that the normal business is producing 58%, other income is giving 42%. I don't know any other company of this size anywhere in the world who is coming 42% of the profit coming out of other income. What it says is that the cash pile on the company is sitting 70,000 crores. It is not finding any business opportunity to deploy. It is just earning a treasury income and interest income out of that. So that is not going very well with the market. Why should anybody pay top dollar for a company for just earning other income, not the business income?
Right, and for those investors who are holding the stock right now, what would you say they do? You did talk about this the last time we spoke about RIL's results as well. You said it's not a stock that we should be using at this price, at this valuation, to play the India story over the long term. So if I'm holding RIL stock, what's your recommendation? Should I be looking for opportunities to book out of this stock?
This won't make any sense as investment bet, not in the 1 or 2 or 3 years, because until and unless that gas production rampage happens, it doesn't make any sense in the near future. I think it's a good swing trading candidate, not investment bet. Swing trading between 650 to 750, in the sense buy around 650, sell around 750. I think that kind of strategy can okay for 100 rupees bounces, but not necessarily an investment.
So RIL, they're disappointing results. The market is not impressed. Jagannathan telling us that it's not really a long-term stock pick at this moment. It's possibly a good swing trading candidate, but if you want to book out of that stock, you want to look for other options. He has brought us 2 stock picks this week that he thinks we should be investing in. The first of the 2 is YUCO Bank. Take a look.
Kolkata-based YUCO Bank was established in 1943. The bank now has over 2,000 centers across the country and also has overseas operations in Hong Kong and Singapore. But the bank's exposure to Kingfisher Airlines has put pressure on their asset quality. Even though profits for the third quarter saw a 44% rise, the bank's non-performing assets continue to remain under pressure. Q3 saw fresh slippages amounting to 507 crore rupees, and the bank's restructured loans has risen to 6.7%. Earlier this year, the stock fell to its 52-week low at 42 rupees, more than a 50% drop from its high in May last year. And despite posting strong interest margins, only 1/3 of market men have a buy call on the stock.
Well, that first pick, YUCO Bank, no doubt, Jagannathan, from the valuations right now of that stock, it seems more attractive than other banking stocks. But as a business, its reach is low right now. Progress is taking time. It's taking time to turn around. Could you tell us why it wins your vote over the other banks available to us?
One thing you should remember is that whatever may be the NPS, still 80% of the bank is owned by the government, meaning thereby the collapse of the bank is virtually ruled out, that there is a government to keep supporting the bank. In that sense, the downside is fairly protected. Second is you are paying just 5 times PE multiple and less than 1 time price to book, so you are paying very, very reasonable price. On top of that, once this Basel III norms and the IFRS gets implemented, what will happen is that the government is expected to put about 10 lakh crores in all the PSU banks put together, meaning thereby all these banks are going to get the rounds and rounds of funding from the government. If somebody is looking for a real investment theme, whenever these mid-cap PSU banks keep going for a dip, keep investing. But UCO Bank, I feel if you stay invested, 200 rupee target, it will not be a big thing, let's say in 3 years.
Alright, so the asset quality has been weak. Does that cause you any concern right now? Do you think that in the long term, they might be able to overcome this challenge?
Asset quality is nowhere close as qualitative as HDFC Bank. But my point is HDFC Bank is available at 22 times PE multiple, whereas UCO Bank is available at 5 times PE multiple. So whether you want to pay 22 times PE multiple for a high quality or you want to pay a very small price for a medium quality business.
SMC Global's Jagannathan is with us as well. And we're talking about his second pick of the week. Now, he has brought us MCX. Take a look.
The Multi-Commodity Exchange of India, or the MCX, is the largest commodity exchange in India and also the first to list in the country. The IPO of the company was oversubscribed 54 times and the stock soared 34% on its debut trading day. MCX enjoys an 88% market share and trades in crude oil and metals as well as agricultural commodities. However, despite its market leader position, the stock has lost about 200 points since its listing on the 9th of March. The company had earlier applied to SEBI to start an equity trading platform. When SEBI refused to grant permission, the issue was taken to court. Currently, SEBI is reconsidering the application and will have to come to a conclusion within 3 months. If the application is accepted, MCX will start trading in equity as well, like the BSE and the NSE.
Alright, that was MCX, India's first listed stock exchange. Now we know that IPO received very strong investor interest, both retail and QIP. It also received a 5-on-5 rating for the IPO, but the stock is disappointed since that listing. It's lost about 200 points. Now, tell us, Jagannathan, from where you're looking at this stock right now. Obviously, with a 5-on-5 rating on the IPO, it means the fundamentals of the company are strong. But where do you see it going forward?
Absolutely great company. You will not get MCX kind of companies every day because it's first exchange ever listed in India and 82% market share in the commodity trading in India. On top of that, clear leadership management wise, and on top of that, we should remember one more thing: 40-50% kind of profit margins, and there is virtual monopoly situation. And moreover, as of now, FIIs, banks, and mutual funds are not allowed to trade in commodity business. Going forward, if these parties are allowed, you can understand what kind of volumes that can be generated out of the commodity businesses, meaning thereby commodities can become much bigger theme than the equities also. And so I think if you have patience, I think 2 years, 3 years kind of thing, 2,500 to 3,000, that kind of price is very much possible.
There's also a possibility of MCX becoming a full-fledged equity platform as well. That's subject, of course, to SEBI reconsidering the current rules as far as MCX is concerned. If that does happen and MCX is allowed to also allow equity trading on its exchange, how will that benefit the stock?
It is a big benefit because, as you would appreciate, as of now, the equity market is much bigger theme in India than the commodities. On an average day, commodity markets produce 30,000 crores of volumes, whereas equity market produce about 2 lakh crores of volume. That means equity markets are good 6 times bigger than the commodity markets as of now. If MCX, with all its management prowess and with all its technical capabilities, if they have given a permission in the stock exchange, I think I'm sure they will do wonders on that front also. And I think that should be a positive for the stock. It will not be surprising if the stock exchange license comes to MCX, then the stock can reach 3,000 even in a year also.
Children, that's the second recommendation Jagannathan is giving us today. Remember, he first talked about UCO Bank and all PSU banking stocks there in the mid-cap range, and he also brought us MCX as 2 recommendations. We have a couple of questions, Jagannathan. Manjunath is his name. He has 260 shares of BHEL, which he bought at 297 rupees. He wants to know, at current level, should he be buying more to hold for the long term?
BHL is not getting new orders. So until and unless that happens, I don't think the stock is going to cross beyond 300 beyond anytime soon. So if you have extremely long-term patience, that kind of like typical 4-year, 5-year, then it's a different case altogether. But I think in the same segment, probably I would have loved L&T as much better bet than a BHL.
Alright, so BHL if you have a very long-term view, but otherwise L&T seems like a better bet. Our next question comes in from Ravish. 75 shares of Aban Offshore, which he bought at 630 rupees. Should he continue to hold it?
It's a decent company. The best part of Aban Offshore is it has good order book. The order book of the Aban Offshore is about 3 times that of the current sales, meaning thereby there is a visibility of the earnings potential and the revenue potential for the next 3 years. In that sense, there is a lot of comfort. But frankly speaking, why do you need to be in offshore business or anything of that segment? There are much better bets. For example, as we were discussing, if you have look for that stability and long-term growth, mid-cap PSU banks is one way of playing it.